Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Markets certainly aren't going on holiday. This week, we saw bond yields briefly jump, gold tumble, and stocks march higher. On the political side, we're seeing Trump's polling improve, and on COVID, there's much more focus on vaccine breakthroughs. We have articles on all of these on macrohive.com or on our Slack channel. And for the cost of a few weekly cappuccinos, you can sign up for complete access to all of this. And as for those of you at a fund, corporate or bank who want much more in-depth analysis, whether it's trade ideas, scenario analysis, models, or insights from our network, we have something for you too. Just drop me an email at bilal@macrohive.com and I can tell you more. Now, as for this episode, I'm very lucky to have Stephen Roach. Stephen is well known in financial circles and beyond for his 30-year stint at Morgan Stanley, where he was chairman of Morgan Stanley Asia and chief economist. And I've been a long-time follower of his work. He's currently a senior fellow at Yale University's Jackson Institute of Global Affairs and a senior lecturer at Yale School of Management. He's an author too, with his recent book published in 2014, which is called Unbalanced, the Codependency of America and China, a topic on which we shall return in our conversation today. So on to our chat. Stephen, welcome to the podcast.
Thanks very much. Pleasure to speak with you today.
So Stephen, I've been a long-time admirer of your work. I've been in the research world for a while, and whichever bank I was working at, whether it was JP Morgan, Deutsche, or Nomura, I would always make an effort to try to read your work. You were always very prescient. You were able to talk about big thematic things. And I was looking at your bio, and you have a lot of experience going over the last 3-4 decades. And many people today are talking about COVID being exceptional, unprecedented. There's all of these terms are being bandied around. So how do you see today's set of events? Is it something completely unprecedented?
Well, perspective is key, and the benefits of having done this for many decades does provide some perspective. The cost of that, of course, as you get older, you tend to forget, but we'll try to refresh that. First of all, let me just say that as a former 30-year veteran of Morgan Stanley, while I appreciate your compliments at the outset, I'm a little disturbed that working for competitors, you were able to freely access my research as easily as you claim to have done. That reflects the fact that I think at Morgan Stanley, we failed in terms of our firewalls and efforts to monetize all of our research as successfully as we could have. But notwithstanding that people attempted a joke, this is clearly a unique period that we're in. I've started my career, with the great inflation of the 70s, working at the Fed, went through multiple crises over the ensuing 50 years, believe it or not, nearly 50 years, from Latin American debt crises to asset bubbles to the Asian financial crisis to the global financial crisis and this pandemic. And if we just use the simple gauge of the global GDP metric, we're clearly in a league that we've never seen before, not even in the Great Depression of the 1930s, which I would say does predate my experience a little bit. Did we have as steep a decline as we have been able to capture through this quarterly metric of world GDP that occurred during the global lockdown? I mean, normally in a global recession, roughly half the world is contracting and the other half is still expanding. In the global financial crisis, that balance shifted in an unprecedented way. About 3/4 of the world was declining at the worst point in that crisis. And that produced what we thought was an unprecedented outright decline in real GDP. And then, this time around, it was everyone. So this is an unprecedented crisis for public health and for the modern global economy. And it dwarfs anything that, any of us so-called veterans claim to have seen before.
And do you think that the fact that it was induced by governments, the recession, in the sense that the government told everyone to lock down, forced all economic activity to stop, does that make a difference to how the cycle will unfold? Does it in some ways make it not as bad as it first appears because it's not driven by an imbalance or super tight monetary policy, which you typically see ahead of previous recessions?
Well, I sort of worry that while that observation is correct on one level, It's an easy way out to explain away the damage that's being done by this unprecedentedly steep recession. Yes, the government's ordered a lockdown, in large part because we were lacking in sort of a public health infrastructure and effective public health policies that enabled us to get a grip on this extraordinary pandemic. And that lack of investment in our safety net was global in scope and reflective of a world that was, just trying to cut corners on investing in healthcare and public health policy. And this is something that is evident in the rich countries, the poor countries, in the US and China, the UK, Europe, you name it. We're all guilty of fixating on the speed or the quantity of economic growth, and we could care less about the quality of the growth experience. And that's a real, I think, harsh indictment on the underpinnings of the global economy. So the governments reacted to this, but they were forced to do that because of, I think, some real flaws in our global growth model.
And on this, historically, the US has always taken a leadership in global events, whether it's a global financial crisis, recessions, whatever. You'd expect the US always to take a leadership role. This time, it's been less clear. That's been the case. And that probably has a consequence on markets, on the dollar and so on. And this is something you've written extensively on. Can you talk a bit more about this?
Yeah, we've abdicated our global leadership role under the Trump administration. And that is one of several reasons why I have recently come out with a very negative view on the US dollar. We've led the charge in terms of deglobalization, decoupling, trade protectionism. We've undermined our once very important support to the institutions that have really built the modern global governance architecture, from the WTO to the WHO. We've raised questions about our major alliances with our NATO partners in the North Atlantic. We've attacked our neighbor to the North, Canada, on ludicrous grounds of national security. And meantime, we have turned in the worst record of any advanced economy in the world in dealing with COVID-19, while at the same time undergoing a racial catharsis, the likes of which the United States has not seen since the 1960s. So on all those counts, the bright shining light on the hill that has long defined American exceptionalism has dimmed dramatically. And I think that's a major consideration in looking at America relative to the rest of the world. And that's why I think it's actionable for the dollar, which of course, like any exchange rate, is a relative price. But that's only one consideration that lies behind my concerns about the fate of the dollar.
And just on the leadership side, it does seem like all the Bretton Woods institutions that were set up, led by the US after the Second World War, they're all unraveling one way or the other. Now, obviously, under the current administration, under President Trump, all of those institutions are unraveling faster than probably if he wasn't there. But do you think that they kind of needed a reboot anyway? Do you think they were fraying at the edges? So it was almost inevitable for them to all start to not function as well as they did during the early period after the war?
Well, first of all, I would take a little issue with the fact that, all the major institutions are unraveling. The two pillar institutions of Bretton Woods, the IMF, and the World Bank, while they do have issues, they're still functioning relatively successfully, although there's some certainly political disputes about IMF reform and the funding and support of these institutions, again, led by the United States. But, I would really hesitate in concluding, that the world and its major institutions are falling apart. Obviously, if you extrapolate the actions of the Trump administration in the future, there's a good chance that would happen. But, we have an election coming up in now, a little more than 80 days. And if there's a change in leadership consistent with what the polls are suggesting, then, there's a good chance that the U.S. will behave differently.
And if we just come back to the dollar, you said there were other factors also explaining your bearishness towards the dollar. Do you want to kind of elaborate on some of them?
Yeah, there are three reasons. We've covered one, the U.S. abdication of global leadership. The other two are America's rapidly deteriorating macroeconomic imbalances, and then finally, a positive case for the euro. On America's macroeconomic imbalances, we have a saving and current account problem that is going to go from bad to worse in a hurry. We entered the pandemic with an exceptionally low domestic savings rate. 2.9% of national income was the net national savings rate. That's depreciation adjusted savings of individuals, businesses, and the government sector as a share of national income. And that was pre-COVID. The historical average, people say America never saves, the historical average draws that conclusion into question. It was 7% in the 45 years from 1960 to 2005. So lacking in saving and wanting to grow and invest, we import surplus savings from abroad and we run these massive current account deficits to attract the foreign capital. The budget deficit, which is the single biggest drag on our net domestic savings rate, is exploding right now. We'll probably average 20% of GDP this year and next at a minimum. And that will push the net domestic savings rate into record negative territory in a hurry. And that will lead to, I think, a new record for the current account deficit, which previously was, I think, a negative 6.3% in the year 2005. So currency adjustments are normal for countries going through extraordinary deteriorations in current account positions, and the U.S. is really moving into unprecedented territory on that regard. More briefly, the third leg of the stool is the euro. I've been a euro skeptic for most of my career. The main reason is the European Monetary Union failed to satisfy sort of the Mundell requirements for an optimal currency zone, largely because it did not have a pan-regional fiscal policy to add to its arsenal. And yet, under the pressure of very intense negotiations, but really coming from the vision and leadership of both Angela Merkel and Emmanuel Macron, the agreement a few weeks ago on the Next Generation EU fund, I think, is a breakthrough on establishing a pan-European fiscal policy, complete with a pan-European bond issuing authority that will create a new riskless asset in the world that is only known one up until now in the U.S. Treasury market. So, the euro, which has been very weak and undervalued since the sovereign debt crisis, I think there's a good deal of upside. It's the most unloved major currency in the world. The dollar, which is overvalued, given three considerations that I just indicated, I think is the most overvalued major currency in the world. And so I look for a large decline. I put a number like 35% on it, largely because that is the way the dollar has corrected three earlier times in the past. In the 70s, it was down 33%. In the mid-80s, it was down 33%. In the 2000s, it was down 28%. 35 is probably going to be the fourth major correction of the dollar in the last 45 to 50 years. It doesn't necessarily mean the dollar's days of the dominant reserve currency are coming to an end immediately, but it certainly raises questions about that status down the road.
And on the macro imbalances, what one measure of that obviously is the current account balance, which you mentioned. When we look at the current account balance over the last 5, 6, even 10 years, it's really just hovered around 2 to 2.5% in deficit. It hasn't really deteriorated sharply over that period, despite the fact that the fiscal numbers have blown out. And even during COVID, obviously there's been a huge contraction in imports, and so the current account numbers haven't sort of blown out. So do you think that looking ahead, we will still see this current account deterioration, given that we haven't seen it before COVID? And then also, presumably, if the fiscal numbers are in large deficit this year, then the flip side is the savings rates, also household saving rates, incredibly high as well, and they kind of offset each other. And then as we go into 2021, then maybe all those numbers contract back towards their recent norms.
Well, good luck with that one. I just don't think it's going to happen that way. I think, to me, that's why I prefer to look at this construct called the net national savings rate. It sums up the household sector, which you're right, the savings rate has gone up, but it weighs it against the deficits in the government sector and the business sector. And it adjusts the numbers for depreciation, because I want to know how much domestic saving is left over after the wear and tear on the capital stock to fund economic growth now and in the future. And the way the numbers are breaking right now is that while the personal savings rate did spike, given the income support measures put in place by the government very quickly and with good reason after the lockdown led to just an unprecedented spike in unemployment, the government budget deficit is deteriorating much, much worse than the surge in household saving that is also arisen. So the net of those, which is the domestic saving, is falling sharply as we speak. And so over long sweeps of time, big periods of downward pressure in domestic net saving do require a significant importing of surplus savings from abroad. And that's what I think leads to the breakdown of the current account deficit. You're entirely right that it's hovered in the sort of negative 2.5% zone for the last several years. But that was before COVID. And, in this COVID era, things change at warp speed. And I think that's going to be a dramatic development over the next year or two.
And on the other side, on the investment side, one of the puzzles almost has been the sort of the chronically low investment, not just in the US, but in many other developed countries over the last 5-10 years, and then the associated low productivity. What's your thinking around that?
Well, those are the questions that, the high-powered policymakers, think tanks, and academics have been debating now for easily a decade. For what it's worth, my own take is that coming out of the global financial crisis in 2009, the pace of global recovery was unusually subdued, even though the world picked up a little bit in, from time to time, and especially in 2019, there was a great celebration of vigorous period of synchronous global economic growth. It really wasn't that strong relative to the pre-GFC trends in the world. So the way I've always looked at investment, and this goes back to my first job as an economist at the Federal Reserve Board in Washington in the 1970s, was that the most powerful model that always explained the ups and downs of investment was the so-called accelerator theory, which is based on expectations of future growth drawn from the backward-looking trends of growth that had been realized. And with the world on a sluggish growth path, why would you want to expand capacity if you thought the growth in the future would be as weak as it had been in the past? And with that footprint of weak economic growth around the world, still an enduring feature over most of the period following the global financial crisis, and with the added corollary that global trade had also slowed down dramatically over that period, I think the perceived need of productive capacity was sharply reduced as a result, and that had a significant impact on investment and productivity, as you correctly pointed out. But look, this is a huge area of debate, and I don't pretend to have solved this in a way that others haven't, but I point this out as an area that at least is of great interest to me.
Yeah. And, you've spent a lot of time covering Asia, China, and obviously under the Trump administration, tensions have really built up between the US and China. Now, the argument, I suppose, on the hawkish side, against China is that early on, it was advantageous for the US and for the advanced economies to admit China into the global system. There was a mutually beneficial sort of cycle where the world got cheap labor from China. It was able to develop and everybody benefited. But then the hawkish view then is that later everything's changed. China's no longer a poor country. It's much bigger, richer, and now it's moving up the technology curve and it's stealing intellectual property from, advanced economies. Also, from a political system perspective, it's becoming more authoritarian. There's human rights violations. It's reneging on, agreements around Hong Kong and so on. So the hawkish position is that something has to change and there has to be more of an aggressive stance from the US towards China. So what's your response to that view?
Well, these are great questions, big issues, and I'm in the process right now of thinking long and hard about them as I prepare for the 11th year in a row my China class at Yale, where I've been teaching since I left Wall Street. I teach a course called The Next China, which looks at where China is going and the relationship pressures being brought to bear on China from the United States and other countries in the West are certainly acute for many of the reasons that you allude to. And I'm not here to minimize the role that China has played in creating those problems, but I would say that most importantly, that the very aggressive actions that have been taken by the Trump administration in recent weeks, but really since, say, March of 2018, when the U.S. Trade Representative Robert Lighthizer first issued his so-called Section 301 report alleging all these horrible crimes against America, workers and businesses. In the last several weeks, the intensification of those charges has been well beyond anything that China has done itself over that period. And so I really take this as more of a political move, well supported by a leaked document that was put out in Politico in April called the Corona Big Book, written by a Republican Senate strategy group, the O'Donnell and Associates, that said, look, basically, to the extent that President Trump is in trouble for handling the coronavirus, and needless to say, he's not just in trouble. I mean, he is getting crushed in the polls because of his malfeasance in dealing with the virus. Their recommendation is don't defend Trump. The subtext is largely because you can't. Instead, attack China. And so this trade-off between Trump's malfeasance in dealing with COVID and the China attack, to me, is central to what's been going on in the last several weeks. You know, whether it's going after TikTok and WeChat, closing consulates in Houston, and this so-called clean network approach of purging any apps and software that are tied back to China as orchestrated by the Secretary of State, Mike Pompeo. And, by the way, there have been 4 speeches given by very senior Trump administration officials from late June to late July, led initially by National Security Council Director O'Brien, followed by FBI Director Wray, then going to, believe it or not, William Barr, the Attorney General, laying out an indictment on economics, an area he knows zero about, and then finished off with Pompeo's view of the existential threat that goes beyond anything that was ever articulated by a U.S. official during the first Cold War with the former Soviet Union. That's setting the stage not for a Cold War, but for something worse. This is politics. And so it's tempting, and certainly the Chinese are, I think, getting sucked into this, to react with indignation and harsh retaliatory actions of their own. My advice is, take these movements and speeches and actions as a manifestation of crass domestic politics. It's likely to get a lot worse between now and November 3rd. And again, hopefully this is not where we will be after the election, but that again remains very much an outgrowth of what happens on November 3rd.
Yeah. And if we kind of leave aside how the Trump administration has dealt with China, so let's say if we imagine it was Mitt Romney was president right now and he was taking, say, a hawkish stance towards China, what would be a more sensible hawkish strategy if you do want to sort of curtail IP violations, censure China around human rights, these kind of outstanding issues?
There are lots of issues, and there's lots of counterfactuals you could run by and sort of redo the circumstances that we've all had to go through. But I think the most important thing that needs to be done is to sort of break down the allegations piece by piece and make certain that you build an evidence-based as opposed to an ideological basis for the charges. And I've written about a lot of them, and I would say that starting with the Trade Representative Lighthizer's so-called compelling case that was made in March of 2018 with the Section 301 report. These are very detailed charges that are made, but they're made on the basis of extremely weak evidence. take the poster child for the Section 301 report, forced technology transfer occurring through joint ventures. If you want to do business in China, you got to turn over the crown jewels to your partner. Well, Lighthizer goes through this chapter, line, and verse, but he admits right smack on, I think it's page 19 of the report, that he has no evidence for the forcing part of the technology transfer. That yes, when U.S. companies get together with partners in any country, they share people, strategies, distribution, and in some cases, proprietary technology of products or services they produce. But the allegation is that there is coercion or forcing. And Lighthizer has zero evidence to support that, and he admits it in print. So, you could go through a lot of the other charges. We need certainly better accountability of our engagement with China and China's engagement of the world. And there are ways to do that without resorting to tariffs and destructive retaliatory actions by the Chinese. So I don't care if it's Mitt Romney or Joe Biden. What I would like to have seen in retrospect or prospective developments is that we hold China accountable for adhering to standards that they've agreed to on the basis of fact and evidence and adjudicated disputes. And that's why mechanisms like the WTO dispute mechanism, they take a long time to resolve, but those are far preferable to than the blunt instrument of huge tariffs, which end up costing American consumers.
And how does Europe fit into all of this? Because they've been stuck in between. The Trump administration has threatened Europe with tariffs and has implemented tariffs and, compromised some of the alliances there. Europe has to deal with some of the issues around Huawei and other issues with China. So Europe in some ways is kind of stuck in between. And historically, Europe doesn't really like to take the lead on global issues. It likes to partner with the US on that side, but Europe's been forced to almost take some leadership here. What's your thoughts on how Europe fits into the global system and global leadership?
Well, I'm sorry if Europe feels uncomfortable about being forced to be a responsible leader here, but that's what comes with the territory. And this pressure that's being put on Europe by the United States to choose sides is probably not the best way to go about forming the most thoughtful approach to dealing with China or with any other sort of economic pressure or threat. And Europe thus far, I think, has been relatively firm in trying to seek evidence-based adjudication of disputes. And I think that's the appropriate and proper way to address that. And President Trump likes to use, the bully stick of the art of the deal, whether it's with, China, Korea, Europe, more recently, once again, with Canada, are not an acceptable way for any nation, let alone the United States, to exercise its leadership, its power in the world. And it's incumbent upon Europe to, raise its hand in objection if it feels that that is not the appropriate way to address these issues. On the other hand, to the extent that Europe has issues with the China's subsidies of state-owned enterprises or the so-called Huawei threat, that it feels comfortable in arguing based, again, on evidence rather than ideology, then Europe needs to move ahead and address those issues accordingly.
And you spent a long time on covering Asia and monitoring it. What do you think of a country like India? Many people hold India up as the economy to watch. It's a democracy. It's got a very vibrant population and demographics look attractive, yet institutionally it's lacking in many ways. What do you think about India's first economic prospects in the long run, say 5-10 years, and then its role on the global side?
Look, I was always pretty constructive on India when I was out in Asia, and I still feel that India has great potential. But, like all of these growth stories, they're an interplay between politics and economic fundamentals, and the political trends under Mr. Modi have been somewhat disconcerting relative to, I think, India's growth potential that still has yet to be realized. I was always fascinated with the India-China comparison. And, India and China had roughly the same per capita GDP, in 1991. And then, India did okay, but nothing compared to what China did over the next 30 years. And India fell far behind China, largely because it really failed in terms of the macro factors driving economic development, saving, infrastructure investment in particular, and being open to foreign direct investment. And some of that has improved recently, but not nearly enough in my regard. India was always, I think, a more compelling micro story with its large collection of world-class companies, rule of law, English-speaking population. But early stage development really requires powerful macro, and relative to China, I think India was at a disadvantage. And, that has been, I think, underscored to some degree by some of the political setbacks under Mr. Modi.
Now, if we come back to the US, so we have an election sort of coming up. If we think about scenarios here, and let's say Biden was to win, what types of policies do you think the Biden administration would implement in contrast, say, to the Trump administration? I mean, how would things change?
Well, look, Trump's strategy was, in retrospect, very simple. And that was to look at everything that the Obama-Biden administration did and reverse it. There was no real sort of unique framework of coming up with anything other than a slogan, which was, make America great again. And, I don't think Biden is going to be as mindless in his approach to economic policy as Trump was, and then, reverse everything that Trump did. I think that, you'll see Biden surround himself, if he were to win the election, with experienced and disciplined policymakers who will be methodical in addressing the issues that need to be tackled by the United States. He's tipped his hand in some areas, like the corporate tax cuts that he felt were unnecessary by the Trump administration when they were put in place. He's tipped his hand on his commitment to climate change through a very ambitious plan of green investment in alternative energies. And I think you'll definitely see him rethink America's withdrawal from the Paris Agreement on climate change, the Trans-Pacific Partnership. He's definitely a believer in collaboration as opposed to confrontation, in multilateralism as opposed to bilateralism or unilateralism. And, I think his policy agenda will reflect those core principles going forward, but the devil will be in the details. And, I think at this point, the focus is more on the campaign than on explicit agenda for action, as it should be.
And, if I just get a bit more personal now with you, you spent a long time at Morgan Stanley and now you're at Yale. I mean, how have you found the transition from Wall Street to academia?
Well, the first thing it did, it forced me to actually learn how to use Excel and PowerPoint. A great team of people working for me, and, I could go to sleep at night, send out some orders, and wake up in the morning and, spreadsheets and charts would be drawn for me. I've had to figure that out myself. That was a really scary transition. But, I love teaching and I love working with motivated, engaged students. They're extremely hardworking at Yale. And, it's given me much more time to really delve into issues. I've written one book. I have another one in the works now. And, I have time to do in-depth research that, the great life on Wall Street just doesn't give you the opportunity to do. So I've enjoyed that very much. Having said that, I miss the engagement in the markets. I miss the exchange with a lot of friends and clients that I had over the years. But, I still get a chance to do that and participate in debate through media or platforms like yours. And I definitely look forward to continuing that in the years ahead.
And just out of interest, I've been speaking to lots of academic friends of mine about this as well. What do you think the impact of COVID will be on universities? Because during the lockdown, there's been online learning and international travel's been cut back. Lots of these top universities have lots of international students. I mean, do you think there will be some meaningful changes in the way universities operate after COVID?
Well, look, I think it's obviously been extremely challenging, and we'll have a better answer to that as we move into the fall term. I look back on the spring term of 2020, that was very disruptive, but, we benefited by having our students in person in class through the middle of March. And, in terms of the length of a term, that was 8 out of 13 weeks we did in-person teaching. So when we had to go remote in the final 5 weeks of the term, we were able to benefit from having built relationships. I was teaching a seminar at that point, and so the students knew me, I knew them, they knew each other, we were working together, and so that remote piece was easier to pull off. Now we start up remotely, and I think bringing a class together will be more challenging. And then it comes back to the questions we started this talk with, and that is, where does the virus go? If we're able to get some control over the virus and relax the stringent, distancing protocols that are keeping us in Yale, we're still going to do remote instruction this term. If we can begin to move away from that and go back comfortably to in-person instruction, then I think, university education will not have suffered a lasting damage. But, this digitization and remote instruction that we're now all participating in was probably a long time coming in any case. And it's forced us to rethink a lot of our models of faculty-student engagement. And I think ultimately challenging but positive terms as well.
And you mentioned you're working on a new book. Can you give us a clue about what the new book's on, or is it still shrouded in mystery?
Well, it's a lot of it has to do with the relationship conflicts that I wrote about in my last book. In my last book, it was a book about the codependency of the U.S. and China. I called it Unbalanced, and I concluded the book by saying, look, codependency is a recipe for conflict, and if we don't address our own economic imbalances, and this was sort of the message to both the United States and China, conflict would be inevitable. And that book was written 2014, and here we are. We're in conflict. So I'm going to go back, and I'm doing that right now, and looking at how that conflict has played itself out, and try to come up with what I think is an agenda for resolution. And I'm hard at work on it right now.
Well, that's all really, really good. Now, if our listeners wanted to keep up with your thinking and your work, what's the best place to find your work?
Well, I'm a struggling academic now, so, go back and buy a copy of Unbalanced, The Codependency of America and China. It's still available in now paperback on Amazon. Read me monthly in Project Syndicate website, where I still write a monthly piece. And then I do write for a lot of other publications and indulge in the self-flagellation of going on various news programs and television and the like. So I'm not too bashful about continuing to contribute and participate and engage in this sort of marketplace for ideas, not as actively as I did in the Morgan Stanley days, but in a way that I hope is still fairly broad-based in getting my views out.
Great. Okay. And we'll include a link to the book and some of the other places as well on our show notes. So with that, thank you very much, Stephen. That was excellent.
Thank you, Bilal. Great to speak with you, and keep up the great work.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.